we're on the verge of another great deflationary crisis. Large swathes, if not all of the rest of the world outside America, are now being engulfed in a kind of deflationary quagmire. It's kind of happening in the matrix, out of sight. What we're trying to get at here is we're trying to look at financial disruptions. Over the next 12 months, we could get a wave of financial distress, and these are my indications of it. Chinese GDP is now bigger collectively than Europe. It's about $18 trillion. China has a liquidity issue because it's had the destruction of so much equity from public markets. $13 trillion. That's 50% of US GDP. It's gone. It's been eviscerated of what was deemed to be wealth. And I would say it ain't coming back in a long time. And of course, the property market is like a virus that creates a bubble, and a bubble which reaches $60 trillion. Poof! It no longer exists, but the debt still exists. We can start discussing how you could plan for this Armageddon. Like, you could actually see its footprint. There's so much money you can make. The next 5 years could be the greatest, unbelievable money-making opportunity in the history of man.
Welcome to the Microscopic Podcast presented by GoldRepublic. My name is Alexej and in this format I invite you to look at the world through different lenses, to see what's hidden in plain sight. We'll dive deep to understand the forces that drive macroeconomics, financial markets, and the emergence of a new monetary system with sound money like gold, silver, and digital assets like Bitcoin. We'll also investigate how geopolitics and power games shape the world we live in, but also what can we learn from history to understand the present and prepare for the future. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at GoldRepublic, you will receive 1 free gram of gold. Just click on the link in the description. Well, I think we're live, Hugh, but this time we're not sitting in a room in Amsterdam, unfortunately. But you're in St. Bart's, and I'm in Amsterdam. It's midnight right now. We just passed midnight, and we decided to give a sequel to our first conversation, which went great. It went bazookas. I think it's definitely it's the second most viewed interview that I ever did, and I think it's also like a beautiful one for you. I mean, I saw a lot of good reactions, mixed reactions, all kinds of reactions. You know how the internet trolls act nowadays. But I thought it is almost a year now that we've talked first, and unfortunately we're not able to make it face to face this time, but hope that this is going to be good enough. Regardless, it's really good to have you back.
Yeah, thank you. So yeah, I think I'm happier being in St. Bart's, albeit it's the cyclonic season, it's the hurricane season, so the island is pretty much closed down, and I'm living a hermit-like existence. So it's actually nice to have a conversation with a human being. Actually, this would be the second conversation of the day, and you've fallen upon me this evening, and when people apologize, say, I feel like I've got a cold, influenza or whatever. Well, I've got a profound disturbance in my mind because I had a very, very captivating conversation with David Levinson, I believe he's called, who is on Twitter and came out of retirement and is teaching the world, anyone who wants to listen, about the intricacies, if you will, of the financial plumbing. And it very much, I think, reverberate within the conversation and the path that we might select. But I'm going to apologize because presently I've got a million broken little pieces in my head, and it's all coming back together, and it's somewhat disjointed. And if I was a more prudent man, I would defer my thoughts. But let's see what happens.
So a year ago, you've said that we will have like a Mad Max style deflation, and that most probably it would this event would the epicenter would be from China. What do you think were like the most important events that now happened since we last spoke, and how did the things that you actually mentioned back then materialize so far?
Okay, so we spoke. I believe you said last October, and you know that Edith Piaf, "No regrets." Maybe I've got some regrets. Now, with regard to the overarching kind of deflationary debate from the last time, I still hold to that. Not had a huge amount of confirmation since then, but I would preface my comments in that I believe, so what am I? I'm a former global macro investor, and I was always trying to underwrite my risk taking with the notion of realizing a gain, which would be the fruits of my intellectual argument. But given the very slow-moving nature, these tectonic plates of currencies and bonds and the GDP of these huge economic blocks, change evolves slowly. And so my objective was, I have to be right within 2 years. Now, within equities, it's like 2 months, but we have to take the lens and extend it somewhat. But you asked me, so let me answer your question. Lessons or observations since that period. And I've recently come across or created what I call the Niederhoffer Rule of 5%. Now, Niederhoffer, or Victor Niederhoffer, to give him his full name, he's still present tense alive, but he's kicking on a little bit. But he was a very prominent and eccentric, I know I'm one to speak, investor, and prolific. And when Victor was right, Victor was really friggin' right. Like he blew that ball way out of the park. And he was a great mathematical genius. And there's a book, I think it's called The Art of the Speculator. It has a wonderful first chapter. Wouldn't recommend the rest of the book. It becomes a little bit tedious and mathematical. But the New Yorker did a very good write-up of it. And I was reading the New Yorker article recently again. And it comes across, we come across Victor in 2007. And in June 2007, the 5-year Treasury yield, not the 5-year, forgive me, the 10-year US Treasury yield hits 5, and it exceeds 5%. And Victor takes a huge short position in the SPOOs in the S&P. And he does so on the rationale that at like 5 being a pivot point where it will encourage fund flows out of the equity market and into the rich harvest of cash. And that, well, thankfully, Victor's short position proved rather short in terms of time expansion, because stocks went on between June of 2007 and late July of 2008, and they were on a tear. I think they rallied at least 26%. And they rallied 26% because 5% seemed to act like a Plimsoll line. If you look at again, I was talking about the oil tankers, the slow-moving beasts of macro. But if you look at one of these large vessels and they have these lines on the hull, and that's your Plimsoll line, and it indicates the kind of load-bearing stress level, and if you and it and they're actually designed where they flip back, and it struck me that 5% Treasury yields are the risk-bearing load for all of the global risk markets. And what's interesting is that, and this notion of it being a Plimsoll, and therefore things counter once we hit there, things happen. The Plimsoll notion is that this century, here we are talking about centuries, but the 21st century, there's a paucity of data demonstrating the 10-year US Treasury bond trading with a yield greater than 5%. The number of days that it's actually achieved that this century, so here we are in year 24, and they are very, very few and far between. And so in 2007, we hit 5, but we didn't pass 5, and we came back, and we kind of, if you will, fluctuated a little bit with the yields coming down. And that set off a ferocious risk rally in the equity market. I recall it well because, I was the other side of that. I had amassed a huge position, again, a deflationary proposition that the Fed would be slashing interest rates to 0. And so that rally was arduous for me. But if you take Victor's story, fast forward to the end of July, there was a lot of emerging stories from the financial sector. We had the bankruptcy of Northern Rock in August of 2008, and then we had a lot of fund closures or the gating of hedge fund clients as you started to get disruptions in the prices of mortgage-backed securities. And then there we were on the 17th of September 2007, and the Federal Reserve cut interest rates by 50 basis points. And that was 17 years ago. And on the 17th of September, the Fed, was it the 17th or the 8th? I think the 17th, the Federal Reserve cut interest rates by 50 basis points. Okay, so now we're joining two timelines together. And what's intriguing also is if we go back to October of last year, the 5-year US Treasury, it hit 5%. And as it scaled to that height, and this Niederhoffer Rule came in, stocks sold off. Stocks were weak. But as you don't need me to tell you, stocks then stopped falling and rallied, and the Treasury again just doesn't like it. There are forces in the universe that seem to pull the Treasury yield back down below 5%, and that's what came to pass. And this time, the rally in the equity market was very ferocious. We saw, I think, a 38%, and counting, because I think we're closing today at a new all-time high. So we're close on a 40% advance for US stocks. And gold's done even better. I think gold's up about 70% over that environment. So everyone that I aggravated, all my dear friends, the gold bulls, they're like, you see, like, you don't know what you're talking about. You're a bum. So, pour your disdain on me. So what I'm saying is we had a period which ended up being cataclysmic and very deflationary 17 years ago. It began with Treasury bond yields through 5. They couldn't hold 5 as they fell. It initiated another great leap forward in the price structure of the S&P. And then the Federal Reserve came in and were cutting interest rates. And we know that they cut, and stocks, they fell. And here we are. We hit 5%, stocks rallied a huge amount. The Federal Reserve just cut. Of course, the universe of risk has rallied. It did so the last time. For 3 weeks, stocks went, yeehaw! But, that it seemed to be the opening of the final chapter, which was the deflationary denouement. And so history, of course, doesn't repeat itself. But my God, it's it's rhyming. And so we have to ask ourselves, well, why is it rhyming? And that takes me kind of a little bit back to the conversation I was having with David Levinson today. I do hope that's his name. Because the people are looking at this and they're going, well, okay, like 2007, I may be dumb, but even I knew there was kind of like problems with the banks and the mortgages and the housing market, and too many people had mortgages and the underwriting standards were poor. And logically, I can understand the events, but this time I look at it, and we'll come on to the problems outside America, but internally within America, inflation, I know it's contentious, but on the official figures, has been wrestled with, and its rate of advance, its year-over-year change, is coming back into the target levels. We're below 3, and really, if you exclude whatever, if you make your various adjustments, I think it's running around 2. But more significantly, it's not obvious the excess in the system, which could suffer a huge haircut and then cause economic adversity. And then finally, US GDP growth is kind of baked in for the next, 6 or 9 months at least, to the summer, late summer of next year. So people are like, okay, that's a cute parallel you draw, but come on, history, it doesn't repeat. So I've got some pushback on that, or I've got some work to do to convince people that that's not the case. So the prevailing markets operate under prevailing prevailing belief systems, and the prevailing belief system is that the U.S. is reckless. It's here we are, and we've had very strong economic recovery, much stronger than the rest of the world from the pandemic lows, and a recovery that seems set to persist. Kind of conditions of full employment and no obvious signs of distress from the financial sector. And yet they're running a budget deficit, so they're spending more than they receive. And now the Federal Reserve is cutting interest rates against that backdrop. And so you've seen a convergence of the performance of the S&P and gold, because they're saying, well, this kind of feels like a tale from history further back, like going to the Weimar Republic and coming after the First World War. And if we just look at common currency, the dollar, if I'm a dollar investor, if we get a profoundly reckless and irresponsible Treasury and Federal Reserve joined together, then the dollar is going to weaken. And of course, again, we've seen the dollar come in from, over the last 18 months, it's probably come in from 112, it's fallen 12%, a 12% devaluation in the dollar. The dollar index today is around 100 and still showing indications of slippage. And so a domestic American investor would say, hey, listen, in that environment, stocks measured in the dollar could go parabolic. That was the Germany experience. And of course, gold would do the same. So there's a big check, boom. And so gold, why doesn't it go to 3,000? And then if you get to 3,000, you'll have people calling it 4,000, 5,000. That's the prevailing accepted belief system. And I'm the other side. And I'm pausing because I'm talking too much.
Actually, there's this, when you say that, the Weimar part, I have to think about this chart that circulated over and over on X, Twitter, whatever. That is actually the gold price in Weimar mark, so the percentage change in gold price that just does like this, and you probably know about that. And to your point about the Niederhoffer Rule, you also mentioned the Japanese banks' reliance on the U.S. Treasury bills, and the fact that the Japanese government bonds, the JGBs, are also a sign, of their credibility in a way. So how do you think that this trend might evolve, and what kind of impact could it have on Japan's financial stability and the broader global markets in that sense?
Okay, so this is when I'm going to try and construct my deflationary argument. So I kind of, we made parallels and we went, yeah, cute, but I don't see the stress. So where's your deflationary event that's going to take interest rates back to zero like we saw in 2008, 2009? And so the principal lead witness in this cross-examination actually is the dollar yen. And I'm a am I a data junkie? I wouldn't know what to do with data. I think I'm data dyslexic. But I was saying to you, the oil tanker, the slow movements. I favor looking at price charts with more and more years, and it drives me crazy. Bloomberg, the television shows, they'll flash up price charts all the time, and they'll be like the last hour or the last day or the last 3 days. I'm like, you end up seeing the scales of my skin. You don't see who I am as the person. So using all of the price data, the weakness, and really it's been a devaluation in the third principal currency of the world, the yen, is off the charts in terms of price significance. That it's a profoundly rare event. The yen had been such a very, very strong currency, and for a very, very long time, and it kind of traded 100, 110 vis-a-vis the US dollar. And then our conversation last October came kind of halfway through this really severe sell-off in the yen, and we went from those levels and we touched upon like 162. And so it's like, well, okay, well, that's significant. That's me going back to 2007, and I'm seeing, the funds at BNP blow up, the hedge funds at BNP blow up, and I'm seeing the Northern Rock, and I'm seeing like other American institutions coming in and getting. I'm like, so there are some flares in the system. Now, where it gets more and more curious is that you can almost pin the donkey's ass, if you will, in terms of that movement in the dollar yen back to August 2021. In August 2021, the wider world became aware of the problems in the Chinese property market, and there was a day in August back then when Evergrande had to announce the ignominy of missing an interest payment on its $300 billion equivalent of debt. And that's pretty much the day when the dollar yen breaks out. So I'm coming at you. I look like an idiot. Maybe I am an idiot. The facts would suggest otherwise. Very, very successful hedge fund manager, global macro manager, ran a fund for 15 years. I had no beta. I only had alpha, and I had an objective not to lose money and to make a lot of money when everyone else blew up. And I pretty much succeeded in that. I retired from that because it became a passionless project. The more that we inflicted regulation and we raised the break even in terms of the profitability of that business, and I closed that down in 2017. Now, the proposition is quantitative easing. Okay, so quantitative, like the gold guys, the gold girls, we love QE because we don't love it, but it's the bet and wire. It's like, I told you, these guys are out of control. They are printing money. Again, we're back to the Weimar. Now, as in everything in life, that's kind of true, but it's not the whole answer. So with quantitative easing, a bank has a holding in the US Treasury, and it sells it to the Federal Reserve, and it receives something back. And what it receives is essentially a digital ledger movement, and it receives reserves at the central bank. And this is deemed to be wonderful collateral. Okay, so banks need collateral. With collateral, an asset, you then look for a liability, and you look for a liability that yields more than your asset, and that's your net interest margin, and that's where you make money. And so the notion was, hey, listen, we're going to take these treasuries away, and they're 10-year, and the duration is, back then the duration would have been maybe 8-9 years. Prices moving all around the place. We're just going to give you the solid Federal Reserve money, and it's kind of like, to use that expression from the 1920s, a coupe de whiskey. It's like, guys, I'm like the parent. I'm the responsible one. Here's some booze. Go and party. Go and have fun. Go and make lots of loans. And I'm sure, as the audience understands, fractional reserve banking. As you lend, then if you get a mortgage, for $1 million. If you're a rich person, you put the $1 million in your bank, and then it replicates, and you create a lot of money. Now, that has been the abject failure of quantitative easing. The Japanese began pursuing this well before everyone else. I think they must be close to 30 years of pursuing that. 30 years, that makes sense. 24, let's call it 25 years. I'm making the number up, but of that vicinity. And the Japanese, with all of this high-powered collateral money sitting on the banks, what have they done in Japan? Nothing. They're like, we don't want to do it. We don't want to do it, and they've labored under this. And remember, they're banks. They're listed on the stock market. They have to make money. And so what we find with the major money center banks from these large overseas economies, and we find it in Germany, Deutsche Bank, the subprime crisis in 2008. The biggest exposures in America were funded by European banks. The biggest rescue plan was for the European banks. The US banks were kind of dumb, kind of stupid. We lost a few, but the Europeans, my God, were like really out of control. So you find that German and Japanese banks, they still have a sense for adventure, but it's international adventure. They're kind of James Bond. They're out there in exotic locations. So again, I'm going to jump back to the Asian tiger crisis. The economy of Thailand, its GDP in the 1990s, it compounded at over 10%. Like the kind of China levels from a generation back. And people loved it. And actually Victor Niederhoffer, Victor loved it too much. He came in right at the end. He came in, my God, it was so bad. He came in, there was a sell-off in 1996 in Thai stocks. And Victor had been watching this party. He was getting more and more money from clients. Like, I got to do something. And he sent his mate, another eccentric dude, a guy who lived off the grid in the American desert, and he said, "Can you go to Bangkok and just give me a report on the sustainability of what's going on over there?" And he's like, "Yeah, sure." And his thesis was predicated on picking up, and I swear this is true, picking up cigarette butts that people had discarded on the streets of Bangkok. And what he was discovering was that people were discarding, like, it wasn't just like people smoking to the filter. They were leaving a lot of the, they're like, and then throwing it away. And it's like, God, these people feel good. Like they feel that prosperity is going to continue, and they're not even finishing their cigarette to the end. And then he investigated the incidence of venereal disease in the bordels of Bangkok. And he was very reassured to find that the incidence of sexually transmitted diseases was declining. Now, Victor never visited Bangkok, and on the strength of this very kooky report, Victor went very friggin' long the futures of Thailand. And and they never recovered. They slipped and they slipped and they slipped, and you got a tap on the back, you got the bullet to the head. The counterparty's like, dude, your time's up. And I think at the end he was liquidating on some of the popular names that would have been down 85% from his initial purchase. So, like the Niederhoffer Rule, you have to take it with a pinch of salt. But it wasn't just Victor. There is a purpose to this story. Japanese banks, I'm pretty sure Japanese banks had not been investigating the incidence of venereal disease in the whorehouses of Bangkok. But my God, were they jiggy and were they down for everything Thai? And they had huge credit exposures. So banks, they have to grow loans, and that's how you kind of control your cost-income ratio, and that's how you kind of nudge and push a bit like SIF. I mean, am I saying syphilis? Am I still on sexually transmitted disease? But Syphilis, the Greek legend, the guy who like really annoyed the gods. Say again.
Sisyphus.
Sisyphus. Yeah, he had a few run-ins, successful run-ins with the gods, and like, we don't like you. And of course, he had to push this boulder up the hill. And that's what the Japanese and the German banks are doing. They go seeking foreign adventure, and they extend a lot of credit. So it's not a huge flight of fancy to suggest that after the debacle in America, so we had the debacle in Southeast Asia at the end of the 1990s. We had the debacle at the end of the noughties in America. But the thing about banks is you recapitalize them like, right, okay, what other crazy shit can we do? And so, the Japanese would be like taking they love their cigarettes. They'd be like, oh, wise man, invest in China. All of our clients, all of our corporate clients, are investing in greenfield expansions in mainland China. And this would be between 2010, 2012. And you could not pick up a newspaper. I mean, I was actively engaged with my hedge fund back then. And you could not pick up a paper or watch the financial TV shows, the lunacy, without some absolutely world-respected guy in a grey suit telling you that China was going to overtake the US, and it was going to be the future. And so, this is the mood music is very, 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 very encouraging. And what if they went, let's go for it. Like let's stop being pussies. Let's turn up for this show. So the question, and if you're still listening, can I just say thank you very much? Clearly, you've got nothing better to do. Now, I can barely watch other people because they all have this pretense and this false knowledge, I would call it, regarding liquidity. Everyone's got a model, and everyone has a chart book. Then, like, can you turn to the diagram on page 59? I'm not that guy. Okay, anyone that tries to, and there's a very, very, very prominent British guy out of London who is just never off with his liquidity indices. People, I know I look like a kook, but I have managed like money for the most demanding people in the world, and for the last 30 years, and I've never ever come across a valid metric that captures liquidity. I trade on principles. Liquidity is created by rising prices. Yeah, prices go up, liquidity is no problem. Prices crunch, liquidity disappears, and there are reasons for that. Maybe we'll come back to that. But one of the principles I use, and again, it's this notion of consternation. I'm creating, you're watching me going, shut up, you talk too much. But one of the principles I use is I look for irony and paradox. I say life is capricious, life is wonderful, but every now and again you're scratching your head and going, that was weird. Like, who would have been the prophet that foretold that? And kind of tends to be Looney Tune guys like me. And so my thesis is, what if the banks that were subject to the greatest temptation And that would be the Japanese, because they've had QE for a quarter of a century. And they've sat there like with all of the booze, more and more whiskey. And the Bank of Japan keeps sending like crates over. Come on, drink it, drink it. And they've sat there going, no, I'm not doing it. I'm not doing it. And so one of the terms that I would use, I would say that quantitative easing has created inert banking reserves. Inert because they have not facilitated new credit lending and therefore money creation. But what if, and it seems kind of plausible that the guys who sat there looking at all of that whiskey for the longest, that he's the first guy that goes, bugger it, I'm taking it. Oh. And it's like, oh, once you take one, it's like, oh, yeah, and you get drunk on it. What if, so what would the mechanism for that be? What if the Japanese banks took their banking reserves, and the banking reserves would be mostly in kind of cash JGB, so very, very short tenor, very short duration, treasury bonds issued by Japan's, the sovereign of Japan. And what if they approached their banking counterparties, international banking counterparties from all over the world? Now, this is called the Eurodollar system. And the Eurodollar system is like a pawn shop. And what if, the Japanese are like, I'm just wondering, I've got $1 billion equivalent of JGB cash. How many dollars would you give me? And the underwriter, the pawn shop owner is like, looks at the watch and like, you know what? JGBs are pretty solid. I will give you no haircut, and I'll give you $1 billion in return. And I believe that was happening. And when you do that, as the Japanese bank, you're effectively short the US dollar and the risk-free rate. And then what if they used that? That was their funding to then extend credit into China. Again, these are what ifs, but I'm trying to reason why the currency popped and like just really devalued at dates coinciding with the emergence of the great destruction of the Chinese economy. I mean, I hope you can see logically why it would take you there, okay? And with regard to China, remember, we were talking off air, but the Chinese economy has gone from, I call it, not me, but everyone calls it the Buffett index, where you take the total capitalization of domestic stocks and you express it as a percentage of domestic GDP. Now in America, we're off the charts. Yeah, I mean, we're like 200%. China, which has the composition of the companies is less attractive. There's a huge state-owned enterprise with a slug of equity, which is quoted on the public exchanges. So China at the peak, which I think was back in, where did we say? Did we say 2017 or 2000?
2000, yeah, you mean the peak?
The peak, yeah.
It was in 2007, right before.
Yeah, okay. So 2007, that was 120%. The Buffett index was 1.2 times GDP. And today, there's been absolute carnage. The Alibaba, I think, is back trading at its IPO price. I mean, go figure. And the Buffett index for China is 0.5. So you've effectively evaporated 0.7% of Chinese GDP. Now, China is now bigger collectively than Europe in GDP. It's about $18 trillion. So we're talking about $13 trillion of what was deemed to be wealth, which is gone. It's been eviscerated. And I would say it ain't coming back in a long time. Okay? Because what we're trying to get at here is we're trying to look at financial disruptions, air blockages. Because here I am, and I'm like, I'm seeing like over the next 12 months, we could get a wave of financial distress. And these are my indications of it. And so you have to remember that because people like me, we talk about, hey, the debt to GDP is very high today. It's 3.5% of GDP typically across the world. But that's supported by everything has to balance. We all effectively live in a ledger world, and it's balanced by assets. But in China, you've had a $13 trillion. That's 50% of US GDP, which has just gone poof. It no longer exists, but the debt still exists. And remember, that's so. In my long lead into this, I said to you that there is no proprietary liquidity index, that you create liquidity as prices go up because you can offer more debt. You can sustain more debt against your balance sheet. And it's the inverse when asset prices fall, and that's why they're so invidious. And that's why you create liquidity problems. So China has a liquidity issue because it's had the destruction of so much equity from public markets. And of course, we've yet to discuss the drawdown. It's contained, it's slow. There's no secondary market really, but the property market is, the property reached a peak valuation in dollar terms of about $60 trillion. Like 3.5 times GDP, and that's sliding. So there's a lot of distress there. And again, let's come back to Japan. Japan, the guys with the cigarettes, China's amazing. And I've taken these Bank of Japan Treasury bills, and my banking counterparties have given me dollars. And what have I done? I've printed money. I have gone and I've created money. I've given money to anyone looking for it overseas. And mostly my prejudice has been anything China. And then China, boom, asset values are like on the wane. So no surprise for me that the Japanese yen has been weak, because every day you have to roll your position in the Eurodollar system. And what I think the conversation, let's have a conversation. So you're the Japanese bank, call me up. I'm listening. My phone. Yeah.
Hello, Hugh.
Oh, hey, how's it going? Now, I've been thinking overnight. I'm thinking. Like I got $1 billion equivalent of your JGBs, and I gave you $1 billion of like cash. I'm thinking, you guys are kind of crazy, and I think you're a little bit over the edge and a little bit too exposed to Evergrande and everything I'm seeing in the disappearing world of China. So I'm kind of thinking that if you want to keep my money, actually, you're going to have to stump up. I'm going to pick a number. You got to wire me $200 million. And then you can keep the rest, but you got to wire me $200 million. Okay? What are you doing? Because remember, you're short. So you are the Japanese bank. You're short $1 billion. And I've just given you a margin call. I'm like, I love you, honey, but start sending me some greenbacks. So what are you doing? You're selling yen, you're buying dollar. Now, all of this is opaque, right? The Financial Times, the Wall Street Journal, Bloomberg, CNBC, the BBC, right? They're a million miles away from that. They don't see this, right? But everyone, no one is looking for irony and paradox. Everyone's looking for kind of logical deductions. And so logically they go, okay, so we know the yen's been very weak. What do we have? The Federal Reserve raised interest rates to 5.25% to 5.5%, and Japan was at 0. So hedge funds came in and they borrowed Japanese yen and they paid nothing, and they put it into US risk assets with a 5% yield. So it was that exercise over and over and over, rinse and repeat. That's why the yen has been weak. And that is credible, logical, and not true. Not the answer. Did that activity happen? Yes. Was that the marginal setting of the dollar yen? I don't think so. I think it was actually these banks who are enormous. And again, you'll see, the Financial Times or some fruitcake on Twitter, they'll publish, the unwind, because now the yen has strengthened. The yen, they have to take action. The yen has strengthened. And we're trading around about 142. And as we speak, God knows what time it is in Japan. It's almost morning in Japan. Almost morning. I think it's probably about 6 o'clock in the morning in Japan. And tomorrow morning, the Bank of Japan are going to announce their interest rate decision. I would say that their interest rate decision is perhaps of even greater significance than the Federal Reserve decision that we've just received. And so like, it's like, oh, there you go. The dollar yen carry trade was $700 billion. It's been unwound. Bank of Japan have got it. Okay, logical, very comforting. Everyone gets it. You can be a dentist, you can be whatever, a great person. And you're like, I understand macro. No, you don't. No, you don't. I don't know who does. Okay, let's pretend I do. I think the temptation for the banks, the Japanese banks, with the dollar yen at 142, and they look at their book, and they're looking at the bad debts, and they're like, man, we got to cover more of this. And if we're talking Eurodollar, the Japanese bank exposure will be in the trillions, not in the billions. Okay.
Why is it the dissociation? Like, why would it be different?
Why would the magnitude of the investment be?
Yeah.
Banks, honey, like, Bank of America has, like, I think a $2 trillion balance sheet. God knows what JP Morgan is, probably $100 trillion, right? A hedge fund, I mean, God love them, but they're like ants on the elephant's ass, So yeah, when you get, we got the best part of a 30% devaluation in the third most actively traded currency in the world, right? That doesn't happen because a few hedge fund, guys are doing, or like a lot of hedge fund guys are doing a carry trade. It does not happen. It doesn't work that way.
So let's go back to China, because that's kind of like where we were at, and we discussed about the real estate crisis and the fact that those Japanese banks are highly dependent on those collaterals that they're with malinvestment in China and all that situation like unfolding. What else is happening? Because the government has also tried to curb down the real estate bubble that was building up. And because from what I understood, it's kind of one of the only things that Chinese people can even actually build wealth with in general. And they kind of blocked the stocks, also went to the toilet. And they're now basically, looking at some form of stark recession, and some might even call it the maybe the beginning of a depression. How do you paint that picture in China overall?
That's a great question. What did I say? I said liquidity is created by rising prices. Okay. What else is created by rising prices? Reputations. Okay. Again, back to 2010 when my Tokyo bankers were going, let's invest in China. It's just amazing, right? Why was it amazing? We said 2007 stocks have been on a tear in mainland China. They reached 1.2 times GDP. And we all thought Chinese bureaucrats were just dope. They're the guys, like they're just smarter than us. I mean, look at their GDP growth. Look what they've achieved. If only we could be half as smart as they are. It's all reputation created by rising asset prices. What did we discover? We discovered that they're friggin' as useless as all the bureaucrats everywhere else. Perhaps even worse, because it is not a free society. They don't have the freedom. Individuals, can we call them? I don't even think you can call them citizens. They don't have the basic freedom principles that we have. And to preserve, if you will, that uncomfortable or fragile status quo in terms of the lack of democracy. The Chinese Communist Party, the overlords, are very preoccupied with GDP growth, and so it's like we got to keep the natives, we got to keep them sedated, and sedation is GDP growth, which employs people. If we keep them in work. And with these huge capital expenditure programs, we're attracting back in the day we were attracting semiconductor fabs, etc. The wages that these former peasant families are earning, everyone's going to put up with it. Like you guys are fascist, but you're making me richer. Okay. And so I think what we now know is that China sacrificed wealth, sacrificed its balance sheet in terms of the amount of debt it has versus the income of its GDP. It sacrificed everything to keep the natives, if you will, in the bubbling jacuzzi, and everyone with everyone benign and not restless. So we can say that wealth was sacrificed because Chinese stocks peaked in 2007. That we've wiped out $13 trillion. So despite, again, paradox. What if I was to tell you in 2007 that the economy over the next, what would that be, 27 years, expands at, I'm guessing 6-7%? And what if I was to tell you that the stock market would lose $13 trillion? You'd be like, get out of here. That's not possible. What did I just tell you? I told you life's friggin' really, really strange. Like really, really strange things happen. Okay? And yet no one's looking for strange things. No one's base case, when you're tail investing, these low probability events that if we strike on them, boom, people lose a lot of money, but the profits make a lot of money. No one's able to construe it because we all desire rational outcomes. Okay, but so the rationality is, they funded real estate and they funded infrastructure programs where the discounted cash flow was negative, and therefore something that cost you $1 million had the greatest likelihood of earning, the cash flow from it would merit the value of the business being, or the asset being, 600,000. Yeah? Now you don't measure the haircut. GDP doesn't measure that. GDP just says we just spent $1 million. So $1 million gets added onto the ledger, and it's like you measure, we've just increased GDP by $1 million or $100 billion. We don't measure. Actually, the $100 billion that we just invested in the real estate sector is actually, we've just marked it to market and is like 400 million. We just lost 60% of value. That's effectively what's happened. That's what's happened in China. Now, but as that was occurring, and as you said, it's tough being Chinese. It's really, really tough being Chinese. You get no return from savings deposits. Yeah, your return, even when nominal rates were higher, it was typically less than the inflation rate, and so your real return as a household was negative. So people start making money on property, and everyone's like, "Oh, what? You can make money on property? Well, I can take the money out of the bank, I can get a loan, and I can get leverage, and I can make money. Me, a Chinese peasant, I can make money." And so everyone does it. And so initially, it's an apartment because your son's marrying, the cute girl from next door. But then it becomes, you're buying your second, your third, your fourth, your fifth apartment, which lies empty, but the price keeps getting marked higher until it doesn't. Right? So the construction of all of those projects was adding about 35% of marginal GDP. So GDP was expanding 6-7% each year, and about 2.5% of that GDP growth was from this crazy wealth-destroying property and infrastructure expenditure. That's gone to zero-ish, yeah. And the GDP growth rate now, they're like, we can do 5. 5's amazing. We can do 5. We can do 5. But to get to 5, they have to fill and replace the hole left behind by the property market and the absence of greenfield. I mean, China will not build a new house for the next 50 years. They're all aging and whatever. And so they're like, what are we good at? What is the one thing we are dope at? And that is exporting. We're just going to export more. Come on, guys. Let's go. And it's like, okay. And they're like, electric vehicles. Let's be number one in electric vehicles. And it's like, and you don't have to make any money. Like, if you're the corporation, it's like, Listen, we're the state. We're sponsoring you. Okay? We just want you to multiply, become number one. And kind of that's what's been happening. Now, this new fervor and religion for using exports as the driver of GDP. The one problem is, what did I say? They're good at it, right? And their manufacturing export surplus is already greater than 1% of global GDP. And everyone's like, oh, 1% of GDP, you're really boring me. But again, we've got like 100 years of data. And like, when you get to 1% of GDP, it's really hard. You don't go to 2 and 3 and 4 and 5. What happens is your neighbors go, get out of here. You know, what's happening is, what did we hear in the last 10 days? Volkswagen closing down domestic manufacturing. Yeah. The kind of one of the biggest, the national, you know, the Europe, Europe is good at making cars. Or maybe I've got to say past tense. Europe was good at making cars. They've got a huge capital stock. They employ thousands of people who've got mortgages, and the Chinese are like, and we put tariffs, and the Chinese are like, we don't care. We're just going to cut the price again. We're going to cut the price, right? So I don't see. China's busted. You know, we all want to talk about, it's the US, it's going to be overtaken. You know what? That proposition was just wrong. It was just wrong. The proposition that China was going to overtake the world is being proven to be wrong. GDP will fail to meet their expectations. GDP, I think in 5 years' time, GDP will be, if it's growing at all, it will have a 2 handle, not a 5 handle. And that would be because of pushback from the rest of the world. Now that has a profound significance. I can't tell you the profound significance that has for the pricing of the stock market and for residential and commercial property and Bitcoin and gold. Has huge significance because the great emergence and the rise of the Chinese economy from nothing to $18 trillion came at a time where, I call it cheating, but there's this thing, the Triffin dilemma, Belgian, French economist, and there are like 3 variables on your central bank dashboard, and you can at best control 2 of them, and one's a bit wonky. And when you start interfering, it's like dominoes, decreasing circles of influence. And China has chosen to run essentially a fixed exchange rate price vis-a-vis the dollar for the last, and really ever since the Thai baht. So this all ties back. Thai baht ties back to what I'm saying, because the Chinese saw this emerging superpower Thailand with this admirable GDP expansion. They saw a peasant-like society becoming rich, and then flighty capital and a dependence on the rest of the world took them down, like decapitated them. The Chinese are like, we ain't doing that. We're hanging on. And so why I call it cheat is they come in and they essentially, the price of dollar renminbi is not market determined. It's determined by the central bank. Yeah. And so you kind of effectively forgo your domestic monetary policy. And if we go back to quantitative easing again, you could say that the striking success of quantitative easing was that it caused China to import from the US a very, very loose monetary policy, which then manifests itself in a property bubble. And then bubbles pop, and that's how you bring down your enemy. I mean, it's a bit like, I hope it's not too much of a jarring metaphor, but the exploding pagers in the war, it would seem, between Israel and Hezbollah, that the QE and everything implied behind that essentially was like putting in ammunition into the an anti-fragile or a fragile element. You built like a sleeper unit, you built it into the Chinese economy. And once you, like a virus that creates a bubble, and a bubble which reaches $60 trillion, boom, boom.
But you think that was an intended virus, or something that was just by the sheer consequences of markets, like the way markets work?
We don't need to know. I think the notion that it was engineered seems. I just don't think they're smart enough to work. It's the type of thing I would do. I don't really see the goons in Washington working this out. But it's so. Think about it. We've had Victor Niederhoffer, and we've had yields at 5% in June 2007. We had like a further huge surge in asset prices over the next year. But there was wealth destruction coming out of a bubble in the US domestic property market, a lot of financial distress. And the Federal Reserve was finding itself taking interest rates to zero. But it was, the John Maynard Keynes expression, it was pushing on a string. No one was playing. Everyone was depressed. And actually, all that was happening was you were the Chinese were essentially getting money for nothing, and they were exporting, and so the fruits of all of this monetary misadventure, or monetary trying to resuscitate the U.S. economy, you weren't getting the fruits of that labor domestically. Instead, it was being seen in China, which was deemed to be the greatest economy ever. So you can see, well, like, why not? I mean, I produced a kind of circular graphic very much along these lines back in 2013, and maybe, hey, boom, we're now showing you. Boom, look at that. And boom, look at that.
Right there.
Yeah. So it doesn't really matter. But what I want to say is, so in subjugating the market, in saying the Chinese saying, yeah, we don't want a market determined price for our exchange rate. There's one thing to say that, is another matter to make it happen. Now, how it happens is you're running a persistent trade surplus with the rest of the world. So you're receiving essentially dollars, billions upon hundreds of billions of dollars are pouring into your economy. Okay. And what you do, SAFE, which is the acronym for the central bank in China, it doesn't confiscate those dollars, but in China you pay for things with renminbi. You don't pay with US dollars. And so the central bank clears the banking system, and it gives you the renminbi, and it takes the dollars. And then with the dollars, it sells it takes those dollars and it buys US assets, and it buys risk-free, like cash, like government short-term tenor US treasuries. And what am I doing? I'm buying treasuries, I'm buying dollars, and I'm selling the renminbi. The renminbi should be appreciating because I'm running a current account and a trade surplus. That's how the system is meant to evolve. It's a system which rewards commercial endeavors. The Chinese commercial endeavors were hyper successful, and therefore China should become richer by its currency appreciating vis-a-vis the rest of the world. But you don't want that to happen, so you sell renminbi and you buy dollars, and you keep the system in equilibrium. Now,
and you think that's the end of it now, or what's
going to happen? Well, let's get to that. There's just one step I want to take. So, you're essentially expanding the stock of risk-free assets. Either the US Treasury issues more, and they didn't really. The US, up until the pandemic, was pretty much hawkish in terms of the amount of debt that it issued. But instead, the private sector, Wall Street, issued trillions of dollars of quasi safe risk-free instruments. And that was the debacle of 2008, because these subprime, these collateralized loans where you take subprime loans from all over the nation of the US and you package them together, that was deemed to be less risky than a government security. And so that what you're doing is, owing to the machinations in the foreign exchange market from the mercantilist nations, you're expanding the pool of risk-free assets, which then the banking system uses as like a collateral to then lend more and more money. And that gave us the bubble in the housing stock. And I would say the continuation of that practice, because China has persistently run trade surpluses ever since, has given you the Buffett index of American stocks being, I think, 205% of GDP. That the manipulation of the Chinese currency vis-a-vis the dollar has been the profound liquidity creator, which has turned the world into the overvaluation of everything. Everything is overvalued. It's going up. The panacea is, shut up, it's going up. I go on Twitter and people are like, shut up, it's going up. Until it's not. So to your question, so if China is now busted, if their trading partners are like, dude, you're not taking down Volkswagen, you're not taking down the automobile sector, we're stopping this. We're doing tariffs, I think, only get you so far, because the Chinese potentially could come in and say, tariffs, we're just going to devalue our currency. What you got? But I would suggest to you that I find it near impossible to imagine that Chinese exports are going to be a growth contributor to GDP in China. And I would suggest to you that the huge dollar flows into China from trade surpluses are going to get less and less. And therefore, China in its FX operations is going to be buying less US treasuries. And therefore, you're going to have less, if you will, of high-powered collateral for the banking system. And therefore, banks will make less and less loans. And we're coming back now into my world of we're on the verge of another great deflationary crisis. So now we started with these outer circles of my deduction. And I'm trying to get you to the center where you can at least imagine a deflationary shock. And it would be a shock because it's certainly not the base, nowhere close. No one's discussing it really today. I said to you that we got to 5% Treasury yields in October of last year, of 2023. And that was the high. And those 10-year yields have fallen almost 100 basis points since then. That also coincided with a devaluation of historic significance in the third largest traded currency in the world. We went on to discuss that China and the genius of its economic management was either on purpose or just a victim of the circumstances which brought quantitative easing out of America. And because China, with this whole Triffin triangle and dilemma of which of the policy sticks you try and take control of as an independent central bank, that China, because it had decided that the most important thing was to kind of run with a persistently undervalued exchange rate in order to lock in its great success in export markets. That the advent of quantitative easing was like a virus that the Chinese economy imported from the US, and which was allowed to fester within the Chinese economy and created a bubble of far greater import than anything we saw in equities. The peak valuation for Chinese equities would have been about 2007, would have been about maybe 15, 16 trillion dollars. The property market on the high tech was measured at the best part of $60 trillion. We were saying that in controlling the exchange rate, that the great dollar inflows from exporting to the rest of the world are then sent back to America, and then in the process you're buying dollars and you're selling the renminbi, and so you're maintaining this false and low price for the renminbi, and so again you're perpetuating your trade success for the next year. So the next year you have even more money comes in, and you go into the most open liquid market in the world, and you buy US risk-free assets, and then those US risk-free assets are used as collateral by the banking system, which lends, and a lot of that lending ends up being to private equity companies, companies doing share buybacks, companies that want to buy a portfolio of property companies, and so rinse and repeat that for 3 decades, and here we are with the overvaluation of everything. And now we're saying that such is the sheer magnitude of China's success in exporting in overseas markets that it seems now that there's substantial pushback from other sovereign trading partners, and therefore my conjecture is that China will be unable to generate a contribution to its GDP growth from the overseas sector. And if that comes to pass, it will not have the dollar inflows from exports, and therefore the willingness to purchase more and more US treasuries, and that will prove to be deflationary.
So for the people that are listening to us and watching us right now, you also have a Substack in which you publish regularly some articles, things you write, videos. It's quite entertaining to read, I have to say. Like your style is just as when you speak is pretty lyrical and full of like poetic slams, I would say, in a financial manner. And in one of those articles, you called it the clash of titans, the clash of the titans. You mentioned the tension between the U.S. Federal Reserve and the offshore Eurodollar system, with Asia striving for some form of monetary independence. Maybe it would be good to elaborate on how this dynamic is shaping the future of the global financial dominance that is ahead of us.
Yeah. Okay. So, I hope this isn't contentious, but large swathes, if not all of the rest of the world outside America, are now being engulfed in a kind of deflationary quagmire. Chinese stocks peaked in 2007. Japanese stocks had peaked in 1989. Chinese stocks have essentially collapsed over the last 2 years. Chinese government 10 and 30-year securities, just the other week ago, actually the yield traded below their Japanese equivalent. So the notion of the Japanification of China is getting more and more credibility the more we see the plunge in Chinese yields. And I said to you that my proposition to you is that Chinese banks overextended themselves in terms of maturity profile. Like they lent long, they borrowed dollars short, like every night. So they had a matching mismatch. They were effectively short the dollar, and they were subject to the repricing of dollar cash, which went from kind of 0 to 5.25 to 5.5. We've seen several instances of obscure Japanese financial institutions reporting huge write-offs, which kind of would question their solvency. Recently, and it is very recent, but the Japanese commercial banks, the stock prices of which they hit the highs that they had recorded just before the great financial crisis. And of course, they had a slide lower. They hit that level, and now they're backing off. And that invites the notion, have they double topped? Okay. And it takes us back into this beguiling monetary policy of the Federal Reserve. Again, I think we agreed that, okay, I get it. They cut 50 basis points in September 2007, but why are they cutting 50 basis points now? I mean, that seems very foolhardy and very reckless, especially in the context that GDP, nominal GDP expansion, is probably firmly set to be somewhere between 5 and 6% for the next 6, if not 9, if not 12 months. What's going on? And what I want to try and answer that question. I don't know if I can, but I want to try. I want to say to you that this next deflationary shock is occurring. It's kind of happening in the matrix. It's happening out of sight.
What do you define by the matrix?
The banking system. I mean, there's one thing, the banking. So let's do the banks that we understand, like these household names, Citigroup and JP Morgan et al. Okay. I am not making it up when I say that the notional exposures on their balance sheets, each of these systemically important, they're called systemically important institutions, and they're called so for good reason. They have balance sheets which are denominated in trillions of US dollars. I think Bank of America maybe $2.5 trillion. To put that into context, that's one institution, probably employs, 40,000 people, and its balance sheet is 10% of US GDP, and that's just one bank. And I'm sure JP Morgan's balance sheet is, on the YouTube, someone going, yeah, JP Morgan's balance sheet is like $20 trillion. They're enormous. But is it hidden? We have notes to the balance sheet with disclosure. Like, is the Financial Times reading those notes? Not really. And as long as prices are going up, no one else is bothering. Okay, so that's a member of the matrix. But at least we can get data. We can measure money supply from the lending and the deposit receiving activities of those banks. The Eurodollar system, forget it, right? Forget it. Like, there is no data. They can absolutely hide it. That is the real matrix. This is the creation of money outside the jurisdiction of all central banks, right? And the central banks are like, they kind of just don't want to know. I don't know why, but they're like, like, our job's tough enough dealing with JP Morgan. We don't want to deal with the damn Eurodollar system. I mean, they have to. It was only, when did we lose Credit Suisse? We lost that. Was that March 23 or 22? I think 23. And the Swiss central bank was getting dollar swap lines. So they are aware of these issues, but in terms of measuring it, it's impossible. One of my papers on the Substack and Patreon, I was taking a leaf out of YouTube. I am the fake Bono, and I think it's the Rattle and Hum album, and it begins with Helter Skelter, which is from the Beatles' White Album. And I didn't know this story, but Charles Manson, the subject, the villain which committed that awful Hollywood murder, he blamed he was driven to such demonic acts by like some kind of like something in the Beatles' Helter Skelter. Complete nonsense. And so Bono begins that album is like, Charles Manson stole this song from the Beatles. We're stealing it back. Okay, so let's vibe with that. Arthur Burns. Okay, Arthur Burns, perhaps the most discredited central banker in economic history. Arthur Burns was president from, I don't know, the early 70s until about 79 when President Carter brought on Paul Volcker. Arthur Burns had the misfortune of being the central banker when we had the first oil price shock, the embargo, the refusal to sell oil to the Americans, which led to blisteringly high price inflation. And it led to Arthur Burns raising interest rates, overnight rates, to 13.5%. And that shock ended. A combination of the shock and those very tight monetary conditions. So that was the highest interest rates ever that the Fed had ever got to. And you have to remember the story in the context that everyone, like the glitterati, the Illuminati who talk about these matters, they all tell you that Arthur Burns was a joke. And my question is, really, what would you have done differently? He took rates to 13.5%. Yeah? Should he have taken them to 25? And the other distinction is that the US GDP contracted 2 years in a row. In 1973, there was a decline in the annual GDP. In 1974, there was a decline in the annual GDP. Okay, and that had only happened. Really, it happened twice before, but really, it only happened once before, and that was 1930. So Arthur Burns had raised interest rates, and he had driven the economy absolutely into a huge contraction to try and contain interest rates, to such an extent that the data was paralleling the Great Depression of 1930. And when the economy lost its mooring, he brought interest rates back down to 5.5%. So why is Arthur Burns discredited? Just circumstances. There was a second oil price embargo. Prices went higher. But what I would say to you, and the whole purpose of vibing with Arthur Burns is Arthur Burns was, I believe, he was taken down by the Eurodollar system. I don't mean they assassinated him. Like you were talking about the Matrix and those guys with like hoods and like, take down Arthur Burns, he's a bad guy, take him down. I'm not saying that at all. I'm saying as consequences that the surge in the oil price led to an immense influx of dollars and wealth into the Arab oil exporters. And they had nothing to do with it. Their populations are like 5-6 million people. And they're like, oh, wow. And what do? They put it on deposit with Citigroup or with BNP or with Mitsubishi UFJ or whatever it was called, 50 years ago. And that takes you into the world of the Eurodollar system. So I'm an overseas bank, and an Arab client, sovereign client, has just deposited $1 billion with me. I'm like, wow, okay, this is pretty cool. So with that $1 billion of deposit, I can create a $1 billion asset, which is a loan. And I look around, I'm like, sovereigns, like banks, they do not have, sometimes they have elephant memories sometimes and sometimes not. But there's a great quote from, I think, Citigroup, like, sovereigns don't default. And so Citigroup et al., they take all of this Arab money, they wash it through the Eurodollar matrix, and they are extending huge credit lines to Brazil in the 1970s. Brazil, would you believe, there's always an economy which is going to overtake America. And back then, it was like Brazil was the sexiest economy. It had commodities, it had the opportunity to build out infrastructure, had an educated workforce, it was big, etc. And so it was the desire and the ability of this offshore banking system to print money, which I think funded the inflation of the 1970s. And I don't think we'll ever see a period like the 1970s again. I think any comparison with the price inflation of the 1970s has already been discredited over the last 3 years. Totally discredited. But it's so yeah, Goddard. I've lost the lens. I've probably lost all the audience, but you got to keep with me, folk. This is a deflationary shock if it happens, unlike we've seen before. I'm going to use the expression, this is the tail wagging the dog. And what I want to say to you is the sheer enormity of the financial sector, the one bank having a balance sheet of $2, $3, $4, $5, $6 trillion. And then this hidden monolith, the Eurodollar system that just spews money around like confetti. I am increasingly joining the dots and seeing huge distress within that financial monolith. And is it a phantom? Is if my curtains move, who's behind the curtain? But you see the movement. And there's a ghost in the room. Did
you have a story about that, by the way?
The ghost or the phantom?
The phantom
is this distress in the financial sector. So the Federal Reserve cutting interest rates. Why do I not think that is supportive of a sustainable, further enormous rally in the gold price or in the S&P? So when I say sustainable, who knows the future? But I presently, I'm very, very sorry, gold bugs, but I find gold is very boring presently. What does boring mean? Boring means that the returns with a probability distribution of like 50%, 50%. I can see it rising to 3,000, 3,200, but I can see it falling or correcting to like 1,900. And so for me just now, I'm right in the middle of the probability distribution. I'm like, it could go up with the same probability. It could go up or it could go down a lot, and that doesn't cut the mustard for me. I have to be invested in things where I think I'm on the bottom, and I can only go higher. And
but isn't it also like more of a question like the role of gold in just modern finance, and you see it purely as an asset and look at the performance, but wouldn't it be more just to compare it as, well, you mentioned it in this article, as a safe haven or as a way of dampening any big losses in case of a big crisis?
Let's play that game. Let's play tennis. I mean, that's what all the folks think. That's what all the folks think. Okay, so let's poke holes in that argument. Okay. The funky thing about gold historically, and historically we could go back to, I don't know, the Romans and before. I don't wish to go that far back. From the liberalization of gold from being pegged and controlled by the global central banks, like when we broke the gold peg to the US dollar in 1971. The interesting thing about gold is that its returns seemed to be exogenously determined. They weren't endogenously determined like the way the stock market and interest rates are by events, in the real economy. The gold just kind of floated around. And so in the 1970s, gold was just friggin' amazing. I just gave you the story about Arthur Burns raising interest rates to 13.5%. Between 1969 and 1975, the average US stock lost 75% of its value. Imagine that today, right? What did gold do? Gold went from what, $35 to 800? Gold went up 25 times in the decade of the 1970s. So there was an inverse correlation. And so if I'm a a pension fund, I want to put these two things together because I don't want to do too much as a pension fund. I just want to put a collection of assets and kind of sit back, have the money come in, pay it out to the pensioners. So I really like gold. 1980s and the 1990s, it's the same, only it's US stocks, which are amazing, and gold really sucks. But the deviation, this kind of one going this way and one going that way, but still when you combine it as a financial planner, I mean, it sounds absurd because you're like, well, you just own stocks, but you're not allowed to do that because you haven't seen the future. And what's good is just having a high confidence factor that the returns are most likely to be kind of radically different. Okay, so 1970s gold was great, equities were sucked, but it was really good for portfolio construction. 1980s and 1990s, gold sucked, equities were really good, again, really good for portfolio construction. And so gold would have had, I can't say prominence given the size of the gold market, but it would be a mainstay of the majority of portfolios. And then we look at the 2000s, and really, since 2007, gold and the S&P have been identical. You can't, if you have a chart of both of them, you rebase it to 100, it's the same chart. They're indistinguishable. Now, that is profoundly boring. If I'm a financial planner, actually, I actually find it hard to own both of them. The whole notion of having both of them in my portfolio was the kind of irregular and the diametrically opposed kind of like one will be good, one will be bad, and vice versa. And now I've got 17 years of data where they're indistinguishable. Okay, so the notion that gold can be a hedge, what are you hedging? You're hedging that the S&P might drop 75%. Okay, well, given gold's just matched step by step the rise in the S&P, I mean, my question is, has gold become the S&P? Which is heresy. But we've had a model flip, and therefore I'm just not convinced.
But wait, sorry, that time frame is a specific time frame, isn't it?
Well, I've given you decades. Like, we liberated the gold market, so you had 10 years of liberation, and I contrasted the performance of the S&P and gold, right? And then we had Volcker and the collapse in interest rates. For two decades, gold sucked and equities were really good. And then for essentially the last 2 decades, gold and S&P have been. I'm just describing the last 50 years.
Yes, but so isn't there like a correlation of why it would explain that they worked in tandem for the last 2 decades? Would that be maybe something to do with quantitative easing that actually started in 2008, or how would you explain that?
Well, so, who knows? There's no right answer. Remember, you could bring the smartest financial and academic minds together and say what caused the 1929 crash, the Great Depression, right? And you will not get a consensus of opinion. What caused the 20% one-day slide in October 1987 in US stocks? You will not get a consensus opinion on. These are not factual. These things just happened. Okay, so it's all conjecture. My conjecture is that people are impatient and they don't want to read all of the book, and they turn to the final chapter, the book of economic history. And in the book of economic history, the central bank is taken down. Each chapter it has a crisis, and it has to become more radical. So the first thing was going to zero interest rates, and then it was having quantitative easing. Okay, and that's where we are. And then you fast forward, this is getting boring, and you read the final chapter, and the final chapter is that the US dollar just gets printed like confetti, and the dollar, the dollar is a basket case, and owning gold was an amazing call. Okay, and what I'm saying to you is you should read the intervening chapters, and so let me tell you about the intervening chapters, because gold's convergence with the S&P is saying the central bank, the the global central banking has lost its intellectual mooring. It's lost its conservatism. There's no probity, and this is all about the fantasy of fiat. Running budget deficits when the U.S. economy is expanding in nominal terms of 6-7% is chaos, and cutting interest rates when the economy is expanding. But this again seems unsupported. That the inflation flare that we saw with the pandemic is set to continue, and if we have any modest setbacks, the U.S. government will be issuing more and more debt, and that is effectively money printing, and therefore, as a U.S. citizen, and let's say you're unable to buy U.S. stocks, you're unable to trade the U.S. dollar. I mean, on that basis, they would believe the U.S. dollar would weaken substantially. I don't know against what, but that would be the supposition. So the only way to protect yourself, especially if you're a pension fund and you've got a 40-year outlook, and you're seeing the death of money, is that you have to come into U.S. stocks and U.S. gold, because both will rise in a parabolic manner if the currency becomes toilet paper. That's where I think we're at peak that view. We're at peak that view. Okay, and therefore I don't think that gold is, I think, trading on the same supposition as equities, like the index, not the individual names, and I think it's missing this profound deflationary shock, which is overseas, and it's now affecting the US. So how is it affecting the US? First of all, it is affecting the US. Okay, over the last 6 months, there has been an absolute waterfall decline in US Treasury yields. Like the 2 years, I think, is down like 150 basis points. The 5 years down, I'm making these numbers up somewhat, but say 150, the 5 year is 100, as you're getting flattening. You're getting flattening. The 10 years down about like 70 basis points. They're all down. And there's absolutely no economic justification for the sheer magnitude and the speed of that decline. Okay, so those declines can only be answered by the notion that people smarter than us engaged in the matrix are seeing shit, and they're getting really, really afraid. Now, I think I can attempt to try and pull the lid. I don't know if I can attempt. I don't know if I can succeed. But I would start with the US mortgage market. So first of all, banks have been great stocks of late. Historically, you don't get to say that too often. They've been great. Profits been really good. They've been extending loans, and they've been and the principal loan extension is mortgages. And today a 30-year mortgage has a yield of 6.17. Okay. Now the duration, the computer model for a bank will tell you that the duration of a 30-year mortgage is 7 years. Now, the reason for that is the kids grow up, they move house, you need a small house, whatever. Mortgages change. The stock is changing with the lifestyle of the population. And so, yes, you extend a 30-year mortgage, but typically you're lucky if you get 7 years. It's an asset with a 7-year duration. Okay. So I'm a bank, and today I've just extended $1 billion of new loans. Okay. And this is kind of like the Eurodollar. It's like off balance sheet I can't say off balance sheet, but it's kind of ledger accounting. So if I've given you $1 billion, right? Where do I get it? Okay. Well, I get it. What I do is I issue. So I'm Citigroup, and I will issue paper. Now, 7 year, the duration. I'm going to issue a 10-year. I'm going to issue 10-year paper to anyone that wants it. So I get into the market. I'm like, I am Citigroup. I've got think of it as an IPO prospectus. I'm issuing $1 billion, 10-year maturity, and it's all fixed. Once it's issued, I can't touch it. Right? the deflation which has brought Chinese bond yields down and touched and went below Japanese bond yields is clearly one of the functions which is out there hitting all global yield curves. And so yield curves are falling. Now, the decline in 10-year and 30-year US Treasuries has an impact on refinancing. So the US household is this remarkable situation where you get a 30-year fixed, but any day you can go back and you can refinance it. Now, obviously that wasn't happening when yields all shot up. You got a mortgage. I think the average mortgage rate is somewhere like 4.25%. But there's a lot out there in a lot of mortgages issued richly by the banks in the last 3 years that might have a 7. Some might have an 8 handle. Some might have a 9 handle in terms of credit risk, right? But this big drop down in US Treasuries means that there's refinancing. And so you thought you had this 7-year duration asset, which is this mortgage loan, but then it just gets refinanced. Right? So now, think of my ledger. I issued this 10-year note, and I can't touch it. It was a prospectus. I promised to pay the bearer. I will do this for 10 years. And I did that to fund this mortgage, but it's just being refinanced. I'm like, ooh, that ain't so good, right? So I'm kind of, I've got to come in. There's many convoluted things, but first of all, my duration has gone out, and so it comes in, and it comes in, and it re-amplifies the movement that the financial system in all of its gigantic size actually has to come in, and it has to buy 5 and 10-year paper, because what it has to do is it has to. So forgive me. We had an asset, which was the mortgage, with the 7-year duration, and it had a liability, which is how it funded it, and it funded it with 10-year. And then this asset now has shrunk with refinancing. Okay, so I can't change my liability. It's issued for 10 years. Okay, so I need another asset on this side. Okay, so what do? I come in, and I buy 5-year, because with the duration on my mortgage book coming down, I need 5-year, not 10-year, right? So as I get refinancing, I become a huge buyer of 5-year US Treasuries, which then that's why I'm saying it becomes a reflexive movement which drives. And then as I drive yields lower, I get more refinancing. Now, the Fed gets this. So, and this creates, what does this create? So Jay had created an inverted curve. We've had and this is a really very, very significant point. The inversion of the US yield curve has lasted now for over 800 days. And what is an inversion? The inversion is that the Fed cash overnight rate is higher than the 10-year. And that's inverted or perverted. It's perverted because you should be desirous of more income for taking the duration risk, but here you're being rewarded for the cash. It's inverted or perverted, okay? But that is really, really good for the banks. And again, which have been one of the best performers, JP Morgan, because the Fed created an inverted curve. And that boosted the profitability of the banks, and it made them take more and more mortgage loans. And these loans, in terms of their size vis-a-vis GDP, enormous, okay? But this deflation out of China, as it pervades and creeps through the Eurodollar system, and it comes into the banking system, and that's an international banking system. And so there are waves of repercussion which are hitting the US, as we see with the yield slipping. I'm creating a reflexive process which is going to create disorder, and where I'm going to be buying. And essentially, I'm buying the shorter tenors because of my duration. And so what you see is 2 years collapsing, 3 years collapsing, 5 years collapsing, forget 3 years, 2 years collapsing, 5 years collapsing, 10 years coming down. But because of all of the dynamic hedging from this gigantic financial system is really at the front end. And so you're getting a flattening in the yield curve. And the flattening eliminates the profitability of the banking sector. And then the banking sector, the other thing you've got to understand, two things. The one thing is, one of the things I neglected to say was the 800 days of this inversion is the longest inversion of all time. And that's kind of significant because this kind of always happens. And it's one of these kind of philosophical questions. Does the yield curve inversion predict or create the recession? Arguably, it's both, because it sets some, it predicts something because it happens, it's followed by recession and bad things. But arguably, it orchestrates, and because of its reflexivity, it actually brings it on. Now, this 800 plus day inversion, I said to you that 1973-74 was rare because we had 2 annual contractions of GDP. The only other time had been 1929. And that was back in the 70s. Now what we know is there was an annual contraction in 2008 and 2009. Okay, so the steepest economic recessions in US modern history were 1930 to 1932 and 1973 to 74 and 2008 to 2009. Okay, so the other group, the yield curve was inverted for 700 days and it brought on a catastrophe. Now we're at 800, and I'm not making this up, but my proposition to you is that the longer the period of inversion, the more severe and the more deflation that's going to meet you on the other side. So I think all risk assets are very, very vulnerable. Now, Jay and the Fed, like their number one role, which is really, really crazy. So the banks there's just not enough profitability in banking for the bank. Like I said, how did we start this? Like today, Citigroup did $1 billion of new mortgages, and it sold 10-year paper, right? Now, what it should be doing is it should be hedging tail, right? Because it can't change its liability, and so it is naked to the proposition of the tail that interest rates go to zero. But if it was to put on that hedge, the margin it makes on the mortgage would be nothing. So they don't do it. And the Fed says, we got you. Don't worry about it. We are tail managers. Like, nothing's going to happen. We got it. Well, so there's an argument that the 50 basis point wasn't surprised, but the movement to 50 basis points is all about trying to keep the curve inverted, trying to keep the banks, the oxygen mask and the US banks and the international banking community solvent. And in the short term, that's been a success. The curves had flattened, and now they've steepened a little bit in the aftermath of the Fed. But moving forward now, I want to propose to you. So, ladies and gentlemen, if you have survived this far, we can start discussing how you could plan for this Armageddon. Like, you could actually see its footprint happen, occur every day to you, and like get confirmation. So what you are looking for is you should break down the yield curve. You should be looking at 1 year versus cash, 2 year versus 1 year, 3 year versus 2 year, 5 year versus 2 year, 10 year versus 5 year, 30 year versus 10 year, right? Now the fastest moving, because it's all dynamic, convex hedging coming out of this enormous financial system, enormous. Remember, the financial system is 4 to 5 times bigger than the real economy. Okay. Initially, it's felt in the very short end of the spectrum. So if I'm right, what you'll see is if you dissect into these minimum yield inversions, you will find that all of the low maturity inverted curves flatten. They're not going to steepen because they're just not going to steepen. They'll flatten. So you'll find 1 to 3 is flat, and then you'll find 3 to 5 years flat, 5 to 10 years flat, right? And then one of the big ones, like, you'll know I'm really right. Believe me, I will. I mean, I don't smoke cigars, but I'll have a hypothetical cigar, and I'll be like, baby, we're going to the moon. I mean, there's so much money you can make. The next 5 years could be the greatest, unbelievable money-making opportunity in the history of man. I mean, I don't say that. I want to say I don't say that lightly, but very, very few people will get it. Very, very, very few people will get it. But if you're listening, the reward is you might be one of them. So the big one, you may really, really have contempt for me. I mean, look at me, I'm a friggin' idiot, right? Don't even have a shirt, I'm wearing stupid goggles. But let me tell you, if you see the 30-year US Treasury yield go below the 10-year, it's coming, baby. This is going to be the biggest smash we've ever seen, and rates will go to zero. European rates will go negative again. Now, to preface that, that happened in June 2023. But please, trust me, I'm a guy in St. Bart's with goggles, but you can discount that one. You can discount that one. That happened in December 2008. Right? And October, December was the waterfall. I mean, gold went from $960 to $600. Like, everything gets sold. Everything gets sold. So there you go. Watching it. So watch for flattening and flattening. Don't be just waiting for them to tell you that the 2's 10. Like, that's too late. We got to get ahead of this curve, right? It'll be 2's 5 or 2's 3's or 1 2's and start joining the dots. Maybe it doesn't happen. Doesn't happen. You wasted your time. Hopefully, maybe I entertained you. But if it does happen, you're going to have a roadmap. Now, the other thing that happens is you can create. I want to propose to you. You can create an equity yield curve. Now, I'm not talking about dividend yields, okay? But I haven't created this yet. But I am. You may create it before I create it. But I propose that you take the Nasdaq 100 and you plot a line where every day is the rate of advance or contraction in the Nasdaq 100 from a starting point 100 days ago. Yeah, so you roll forward every day by 100 basis points, and you're looking at the momentum coming into US equities, US high duration equities. The 100 Nasdaq, or the FANGs, are the highest duration assets in the market. And again, in my world, it's no surprise, because what did I say to you? I've got this duration mismatch out of my mortgage book. And these banks are so enormous. One of the other hedging trades they do is they will buy the most high duration equities. So, no surprise that Nasdaq 100 has been on fire as these banks and their convex and their duration mismatching is coming to the fore, coming they're buying. Now, so I would do that. I want to see the rate of change, and I think what you see is you see a huge flare in the momentum, the performance of those stocks. So what I also want to do is I want to have another chart. And they're both 3 based 100, and I want the 100-day again rate of change in the S&P. And I want to take the 100-day rate of change in the S&P. I want to take away from that the 100-day rate of change in the Nasdaq, the 100. Yeah. And so what you would find is you had a huge inversion, which is Nasdaq outperforming the S&P. But what we know is that peaked in the summer of this year, and that is beginning to flatten. Now, if you see 100-day basis, I mean, you can use 50 days, you can use 30 days. I haven't played with the data yet. But if you see a flattening, if you start to see the S&P's rate of price advance exceeding Nasdaq, that's another really bad indicator. So for me, hedging from this Eurodollar monetary gigantic system has led to the FANGs, and it's led to the expansion in gold. And so for me, I can understand why gold and the S&P now have been almost identical, and it's almost impossible to separate them, because gold does not pay you any interest, any carry. So gold is kind of like a zero coupon. It's the highest duration commodity you can buy. So it's kind of like a FANG. So it makes sense that they will rise, and then if they're all going to blow, they're going to blow at exactly the same point. And you think, if that's your hedge, if you're owning, imagine you're owning the Nasdaq, you're like, I've got to own NVIDIA, really, but I'm okay because if NVIDIA blows up, gold will be fine. If they blow up together, and I saw some of the smartest people in the world who had a hypothesis very similar to that in the 3rd and 4th quarter of 2007. They knew there was going to be a huge crash, and they owned gold as the hedge. And when all of that duration unwinding of mortgage rates came through, you saw almost a 45% decline in the gold price, and they got clobbered. If I'm a mutual fund and I can't have cash, right? So the playbook now is, with this unwind and as treasuries come down, and it's happening, the playbook now is the equity inversion flattens, which is to say that the S&P starts to outperform Nasdaq. And then we don't do different tenors. What we do is, what you should start to see is, and again, you're seeing it, consumer non-discretionary stocks start to outperform. Their 100-day rate of change goes very, very positive. And then that'll be followed by utilities. They'll start flying going really, really positive. Now, if you see all of that happening, you do not want to be in gold. You can be in gold for the rest of your life, but I'm not here to address the hodlers. Like, if you're the person like, I'm never going to sell my gold, go away. Like, you're wasting my time. Because I'm not. It's indefensible to say that something potentially, that objectively we could reach a conclusion that gold could fall 50%, but forewarned you would do nothing. I mean, that's preposterous. Why is it preposterous? Because if that happens, you could then own twice as much gold, because you were able to secure it again at a level way below the prevailing price. So anyone's like, I just own gold's going to 5,000, 6,000. You're wasting my time, right? You're welcome to your views, but you don't belong in the community of investment. This conversation has been about trying to educate. It's been about the education and the art of speculation. Like, just sitting there and taking whatever punishment comes is banal. That there's almost nothing I can own. Right?
Okay, so that's the bottom line then.
Well, no, because we're going to look at this chart, and we're going to look at this chart. And what these charts show you, they show you what you should own. They show you that no one sees this. I mean, like, again, look at me, right? Look, stupid freaking goggles, right? You know, boom. Look at me, right? You know, who the hell's listening to me, right?
Well, I am.
Charts show you that the bonds, the treasuries have been catastrophically bad, right? You know, the long end, if we look at the exchange traded fund, the TLT, price halved the last, 2-3 years. Went 180 down to like 85 and presently bobbing around like 95, 100. Right? And the charts that we're looking at show you that on using all the data we have, the bonds have never been as oversold vis-a-vis gold and equities. They've never been as oversold as they are today. And what I'm talking about is a reflexive reaction out of the gigantic and hidden financial system that has to buy more and more and more bonds. Imagine owning them. Now, how this happens, and forgive me if you've been following me on Twitter and stuff, I've been not lazy, but my 2-year window is like, yeah, own the TLT. But actually what you do just now is got to game the system. Like, they're going to buy, you should own, or you should try and create an ETF that gives you proximity to the lowest yielding treasury, right? So essentially you want to be in, there are ETFs, you can own the 2-year, right? And like I said to you, when we see the inversion go to flat, then you jump into the 5-year. And when that flips, then you jump into the 10-year. But when the 10-year rate of change, when it's trailing 100-day moving average starts to accelerate, and the 10-year and the longer duration are moving faster, like the price is gaining in price faster than the 2 and the 5 and the 10. Deflation's coming to town, baby. Deflation. So we got a roadmap. But I'm sorry if it was cookie, but that's how these things happen. Everyone is logical, right? And I hope there was logic in what I said to you, but you got to be a little bit batshit crazy.
Yeah. Well, that's clear, I think. I think this is definitely the biggest deep dive I've ever had with anyone. And yeah, I think it's a lot to digest. I will make dreams about it because it's 2 a.m. now. I thank you dearly, Hugh, for just giving us this opportunity to peek through your mind a tiny little bit.
Well, I promise to everyone that when this finally comes up, I'll be reading the comments. I love the comments. You're like, you bring your disdain on me. I love it. I don't care. I am very, very, I'm very, very fortunate that I can do whatever. They could catch me taking drugs. They could catch me, I don't know, like in a dodgy sexual situation. My brand is toxic anyway. But it's always the cookie people. You've got a better chance with the cookie people when the world flips and no one sees it. So, and like I said to you, I was apologizing in the beginning. I was like, I don't have a cold, but I've just had an influx. My mind is just like flared because I had this conversation with David Levinson earlier. And so I've taken a lot of my thoughts from that conversation and put it into my usual. And so what you're seeing is I've never presented like this before.
Wow, a nectar.
There you go. You should go to sleep.
I will go to sleep for sure.
Excellent.
I'll have your voice in my head.
Cool.
Thanks for watching. If you liked this episode, give it a like and don't forget to subscribe. Leave your actions down below in the comment section. And if you want to watch more videos, feel free to check the most recent video, but also any other video that we've had published on the channel before. See you next time.